Hey, what's going on, Cashflow hackers? It's Chris with Life 180. In this video, I'm going to be talking to you about the 4 lies about whole life insurance that Dave Ramsey makes all the time, and I just want to set the record straight and kind of explain why I call them lies.
Here's the thing. You have a savings element to a cash value policy called cash value, $30,000. You have an insurance element, which is the life insurance that's paid if you die. The great ripoff of cash value life insurance is that you will never get both, and you have paid for both.
Now, here's the deal. I want to get right down to the heart of this and explain kind of where I come from the Dave Ramsey perspective. I don't know the man. I'd like to think that he really believes in what he's doing. I think as a whole, he's done a lot more good than bad for people. He's absolutely been wonderful at helping people eliminate toxic debt in their life. You know, when it comes to helping people like simplify their life financially and learn basic financial principles, he's great. Eliminating toxic consumer debt is a fantastic thing. I would also say that a lot of his stuff that he teaches is very kind of one-on-one and very simple. And honestly, if you need help with the discipline side of it, well, then he's a very structured person with a good structured program that is going to help you build the discipline and the skills that you need to eliminate that debt and build new habits. Now, from a financial perspective, there's a lot of inefficiencies in what he says. And when it comes to Dave Ramsey's perspective on whole life insurance, the challenge that I have with him is that several of the things that he says are either outright lies or he's massively misinformed. Now, that said, he's been doing this a long time. And I would hope that somebody in his position would do the due diligence to kind of take a look and realize that whole life insurance is not everything he's saying it is from a negative perspective. And it's actually got a lot of the upside to it. And I think a lot of people, once they do the research on their own, and I get a lot of these phone calls, they realize like, wow, like everything Dave is saying, well, what do you mean whole life insurance can do this? Dave told me it couldn't. Well, all right, so here we go. We're going to get into it. And so I guess the challenge that I have with it is I'd like to think that he means well, but you know, I guess I'm a little jaded. So full transparency, I'm a little jaded by Dave because, you know, he preaches biblical principles around money, yet when people call him about money, he calls them stupid and he's condescending, and he's just got this tone with people where I just think his ego is a bit too inflated and he's demeaning to too many people. And to me, can't do that out of both sides of your mouth. You can't preach biblical principles about money and then not act in a biblical way when it comes to other people, especially on the forum and with the platform that he has. To me, it's just massively hypocritical. And then the other thing about it is, if you've been doing this as long as he has, he knows the truth. Like, it just probably by the time he learned the truth, it didn't align with his values or align with his, not values, but with his business model or something of that nature. And so my encouragement to you is to really think about this and like listen to what I have to say. If you get to the end and you disagree with me, well, then at least you heard both sides of the argument and you're able to come to a conclusion of your own that's educated with 2 different perspectives, right? I fully realize not everybody's going to agree with me, and I fully realize I'm probably going to get a lot of troll messages from this, and that's okay. But without further ado, let's just get into it. All right, so the first thing, and I got 4 things that he says that I'm going to touch on. The first thing he says is when you have a whole life insurance policy, you don't have access to your money early. So for instance, he says, why would I put my money into my policy, only have to wait 8 to 12 or 15 years to be able to access that money? So check this out. Here's what I want to show you. I'm actually going to share my screen, put myself up in the corner. We're going to talk about this a little bit. This is an actual illustration of a policy where you can see this is somebody, and I wanted to use an example because let's say you had money in a savings account. We have a $10,000 a year premium. We got $110,000 going in year 1, assuming that maybe you were doing the baby steps, you're following Dave Ramsey. Year 1, you had $100,000 sitting in safe money, maybe as your emergency fund, as your rainy day fund, right? And you went in and you took the money out of your savings account and you put it in your whole life policy, which, by the way, would probably give Dave Ramsey a heart attack, right? Like he would have a conniption. I would love to be able to get on his channel and talk about this. But you can see here, check this out. Year one, out of that $110,000, you paid $101,000, or you have $101,803 in net cash value. But look at this, you also get this huge death benefit, $1.78 million. Now, what did you do? You gave up liquidity of $8,197 is what you gave up in liquidity. So basically, you use that $8,197. It doesn't really work this way, but I'm really trying to simplify this from a cash flow perspective. By doing that, you pay up, you've basically paid for that insurance. I don't want to use bad lingo. You're not paying it up because you're going to still make payments. But you know, from a cash flow perspective, that's how we're thinking about it. Now, the next thing, next year, you pay $10,000 in premium. Check this out. Your increase in net cash value, the policy goes up by $10,953. So the policy's growing, the cash value is growing by more than you're contributing to the policy. Year three, you put in $10,000, it's growing by $11,609. Year four, it's growing by $12,322. Year five, it's growing by $13,183. Check it out. By year five, I've put in 110 plus 10, 20, 30, 40. That's $150,000. And by year five, I've got liquidity of $149,869. So it's basically break even, all things considered. And I've got this $1.851 million of life insurance. So how Dave Ramsey looks at this and says, you got to wait till year 15 down here to have liquidity. By the time year 15 comes into the equation, I put $150,000 plus $100,000, that's $250,000. I've got $325,000 worth of cash value plus $2,083,000 in death benefit. All the while, this is going to continue on, and I'm going to get to the next conversations and the next talking points and the lies that he's talking about. But you can see here, you have liquidity of your cash value in your policy right out of the gate, year one, if you design the policy properly. Now, to Dave's defense, what I think has happened is he's seen a lot of poorly designed policies. But it's like anything else in life. There's plenty of areas in life that we can look at things that were done poorly, but that doesn't make the product bad. It just makes that how it was done bad, right? Like, and so this is an opportunity, and this is the challenge. So to this point, I will defend Dave. You have to work with somebody that knows what they're doing. By designing a policy like that, what happens is it opens up your ability to have access to the cash value, but it reduces the commission amount for the agent. So you have to take a huge commission cut as an agent to be able to do this for your client. And so that's where you have to work with the right people. And most agents are not trained to do that, but that's why I'm so passionate about doing this, because I truly believe that when you do it this way, there's no more powerful foundational asset for emergency funds, for opportunity funds, to have your safe money, because you're basically getting, from a long-term perspective, bond-like returns, which are gonna dwarf what you're gonna get in a savings account with savings account liquidity, right? And so that's kind of a big deal. All right, so the second lie that Dave says is that you shouldn't put your money into a whole life policy because when you die, the life insurance keeps your cash and you only get the death benefit. So he basically positions it like they're trying to steal from you. Let me explain why that just isn't the case at all. So let me do this again. Let's go back to this same policy design, right? And so what we look at here, and I'm gonna erase all the markings that I have at this point in time to just keep this clean. So when we go look at this, let's take a look at year one, right? And so year one, let me erase this here again. Year one, you have that $110,000 that goes in, the $101,803, and you have 1.781 million. Now, in cash value, right? And so now what happens is the next year you put in $10,000. Your cash value grows to $112,000 right here, 112,756. Now, what he says to you is like, why would you want year one? You're paying for you have $101,000 in cash value. You have 1.781 million in life insurance. So what he's saying is like, you really don't have 1.78. You have 1.781 592 minus 101,803, right? And so like all intents and purposes, it adds up to be, I'm not going to do all the math here, but it ends up to be about 101.68 million-ish, right? So he's going to say you have 1.68 million. You don't have 1.781 million because they're going to keep this cash value. Well, that's the case. That is true. When you're paying for the insurance, you're not really paying for this 1.781 million. You're probably paying more for that 1.68 million. That is what your insurance charges are based off, and then the cash value will increase that. And here is the case in point with that. Because what happens is you could see the next year you put in the extra 10,000. It grows to 112, so the cash value went up by what? $10,953. Well, the next year, check this out. I'm going to just erase this and do a bit more math with you. If we look at that, the next year you have 1,797,774 minus the original 1,781,592. Okay, so we got 2. We're gonna go 6, 17. 17 minus that is 8. Minus, or yeah, the 1, and then bang, 6, 1, 0, and 0. So what we have here is this account went up by $16,182 while your account value went up by 10,000. So you contributed 10,000. You had your net cash value go up by 10,953, and so that's grown all the while your death benefit. And this is the power of paid up additions. So paid up additions are paid up additional permanent life insurance. And so what happens is, in order to get the cash value, and not only do you get this cash value increase, but you also get more death benefit that's paid up. Now, in order to get this big chunk of money in there at the beginning, we had to utilize what's called a term rider. So out of all this life insurance that we have, right, from here to here, a portion of that is permanent insurance and a portion of that is term insurance. So it's a hybrid model, right? Because Dave Ramsey would tell you, you probably need term insurance while your kids are at home and so on and so forth. And I would agree with him that you probably do need more at that point in time. Now, I can make a lot of arguments that I'm not going to make in this video why you probably are going to get to that age and want more later in life. That's another conversation. But the bottom line is, if you wanted and the term rider dropped off, we could do some things to extend this out. But you can see the term drops off, and now you have only permanent insurance. That's why the number drops from 2 million to 709, and you have the cash value, and I'll get to there in the next point. But the bottom line is, look at this. As every year goes, you can see from year to year, 1797 goes to 1814. Meanwhile, the death benefit is growing by the cash value. Now, the question is, why is that happening? Why does the life insurance increase the cash value? Because will they keep this money? Yes, they will. They're going to keep this money at any given year. They absolutely are. But what are they also going to do? They're going to increase your death benefit and pay out more. Why? Because this death benefit gets paid in a tax-advantaged way. If you were to have your money in a term policy, which would be a smaller term policy that wouldn't be increasing, by the way, it'd be a level term for a fixed period of time, this 15 years, apples to apples, that is what it is, and then have your money in a savings account, this money would be completely taxed, and the smaller number over here would be tax-free, but this number would be taxed. So this is just a way to pass the money on in a tax-efficient way, is by paying the death benefit, and the life insurance would keep this 194 in that year, and they would pay out the 1915. But mind you, if I go 1915 minus 194, it's still bigger than the 1.68 that we actually had in insurance. So because you're utilizing paid up additions, it gets better and better and better. The facts are, I know Dave knows that this is how it works, and I don't understand why he continually misleads and perpetuates this false story about the atrocity about how life insurance companies steal from you, effectively, is how he positions it, and they keep your cash value and only pay your death benefit. That is the number one comment that I see from people in the comments of my videos, and it makes no sense to me why he kind of continually perpetuates that story when nothing could be further from the truth. And in fact, what he's saying is an atrocity, and this evil thing that the life insurance companies are doing is in fact done for your benefit. So that's what I got for that. All right, so the third thing that Dave Ramsey says that is a lie about whole life insurance is that the payments are rigid and they're not flexible. And if you don't make your payment, you're gonna be in trouble. The policy's gonna lapse. The company's gonna make you surrender your policy and you're gonna have no cash value to boot. Well, there's a couple things that go with that. And once again, I'm gonna go back to the board. So if we go back to that, we have to look at the overall original policy design, right? Let's see here. So we have to look at the original policy design, right? And so when it comes to the original policy design, we have to say, all right, well, what is the cash value? What would we be surrendering? And what would I need to do? Now, in this policy, it's a 40% base policy. I'm going to just tell you what it is, and it's 60% PUAs. So 40% base, 60% PUA. So with that said, what are the requirements? Well, the requirement is 10,000, or the premium payment is 10,000. So out of that, 40% is base. So that means 4,000 is base, 6,000 is PUAs, right? And so the 6,000 for PUAs is not required any given year. The only part that's required out of this $10,000 premium is the 4,000. So it could really be 4K is all you have to pay. It's anywhere between $4,000 and $10,000. I don't know about you, but for me, from my perspective, that's way more flexible than people realize. And if we believe that we need to pay ourselves first, if we believe that we need to be saving for our future, and we've got this foundational thing set, well, then we should be able to manage $4,000. Now, here's the other deal. It's not a lot of stress on the policy. Here's why. Let's say in year 3 or 4. Let's just circle year 4 here, just for a focal point. If we cannot make this $10,000 premium payment, what happens is we could go over here to the loan or to the cash value, and we could actually, it would be based on year 3. We would go to this and we'd say, all right, we got 124 grand. We could actually borrow against this the $4,000 to pay this premium. It wouldn't be the full 10,000. It would just be a $4,000 premium payment, 4,120, because there is in this policy specifically, there's a $120 annual minimum for PUAs to keep that rider intact, and you always want to do what you have to do to keep that in place. But the bottom line is, when you do that, it's really powerful, right? Because it gives you that flexibility. You can leverage the cash value that you have to keep it in place. Now, would I suggest doing this? No, obviously not. The principles are, you want to build the financial habit of making your premium payments, because this is what's going to help you build this forced guaranteed savings plan that's going to get you to where you want to go to meet your financial objectives. And if you don't do that, well, then obviously you can't expect to be successful. Obviously things happen. Obviously there's a chance that you get unemployed. Obviously there's a chance you have a year or two where it's challenging. But at the end of the day, you can manage this very easily. If you needed to do 1, 2, or 3 years where you're making this $4,000 premium and just managing the gap there, and then you can make up for it after the fact. When you get back on your feet, you can accelerate and get back on plan for your goals and get the policy back on track. All the while, you don't have to worry about the policy lapsing. The only time you have to worry about the policy lapsing is if you buy one of those poorly designed cash value policies that would have 0 cash value right out of the gate. So at the end of the day, these policies are much more flexible than Dave Ramsey wants to let on. Once again, I can't tell, quite frankly, if he's aware of what he's doing. My gut tells me he's been doing this for way too long to not know what he's talking about. And quite frankly, at this point in time, for him to be talking so much trash without knowing, it's just malpractice and poor advice at this point in time. And so that gets me to the fourth lie, is that it doesn't make sense to pay interest for borrowing your own money. And so it doesn't make sense to pay interest to borrow your own money. So what I'm going to do here is I'm going to go back here. I'm going to clear these strokes. We're going to start from scratch again. And here we go. We are going to get into this. So what he's saying is, it doesn't matter. Why would you, let's say we get to year 2 here and I have 112,000, and let's just go out here and let's say I want to borrow $50,000, I don't know, for down payment on a rental property. Okay. We want to buy a cash flow asset. Maybe we need 20% down on a $250,000 property. We need 50,000 bucks, and that is what it is, right? So we need this $50,000. So what he's saying is, why would you, Dave Ramsey would say, go pay cash as a down payment. I've got a lot of other videos that would explain to you why paying cash is absolutely the worst thing you could do for down payment, because the opportunity cost is horrible. Your home is not a great place to store your capital and your net worth because there's a lot of risks. And I'll link that video up here if you want to go check it out. I'll also put it on the end screen so you don't have to leave this video in the meantime. But here's the deal. The $112,000, you have access to 50. What he's saying is, let's say right now, let's say you had a 4% interest rate, okay? You had a 4% interest rate. He's saying, why would you want to pay money to access your own money? Why would you pay an interest to borrow your own money? Well, that in and of itself, those words show me that he doesn't understand what he's talking about, because you're never paying to borrow your own money. Because here's the deal. This is going to have a dividend and a guarantee that comes with it that gives you the return in this. This is going to go up and up and up and up and up. It's going to grow on an uninterrupted compounding basis. Think about this as a banking account on steroids, right? It's going to get you a better return. And the reason it's liquid is not because you're ever pulling money out of your policy. There's a difference. For you to tap into this net cash value and actually take money out, that would mean you would have to withdraw your money. You are never going to withdraw your money, or very seldomly are you going to withdraw money from your whole life policy. So I want to make sure you understand that right out of the gate. You're never going to withdraw. What you are going to do is you're going to take a loan against your policy, right? So you're going to loan against. Another way to put that is to collateralize your policy. So what happens is, as we get to year 2 here, and we have this $112,000, that means we can leverage and collateralize a portion of this and guarantee this $50,000 loan, pay the 4%, guarantee it by the death benefit, with the death benefit. So if anything happens and you die, they're just gonna pay out the death benefit minus whatever loan expense there is. You take that $50,000, you put it into cash flowing real estate, right? So put it into real estate that cash flows, right? And then as it cash flows, you take the cash from the cash flow and you pay back the loan, right? It's that simple. So if you do that, you're going to put yourself in a position where this money in this column never stops growing, even though you're paying this interest. If I'm paying 4% and it's growing by about 4%, well, then I'm never interrupting the compounding of that money. And when you understand the power of compounding interest versus amortized interest on debt, you start to realize that I could earn the same interest. I could actually earn less on the interest that I'm compounding than I'm actually paying in interest, and it actually works out. This is just math, folks. Like, it is what it is. And I guess I've got other videos that get into the details of that. And if you want to learn more about that, I really encourage you to get out a calculator, bust out a spreadsheet, like build an Excel sheet and just show yourself compounding $100,000, compounding it at, let's say, 3.5%, and then showing an amortized debt that you're paying off at 4%. So you're earning less than you're paying, and you're gonna find very quickly that the 3.5% compounds and starts earning more very quickly than you're actually paying in interest. This is just math. That's why I always tell people math and money are different, and how they work are different. And you have to understand this stuff. And so when you talk about the fact that, you should never pay interest to access your money, why it makes no sense to pay money to borrow your own money, it's just because you're never borrowing your own money. What's happening is you're growing the cash value in your policy, and that money is going to continually grow. And contractually, the life insurance company is obligated to give you loans up to a certain amount of percentage of the net cash value that you have in your policy. And so if you design the policy right and you have it liquid, it eliminates most of the risks, right? Like, and listen, there's going to be a certain element of this where you got to be diligent, right? But there's no difference in that between anything else in life if you want to achieve anything significant, right? If you want to have any level of financial freedom. You have to be dedicated. You have to be diligent. You got to do it, right? Like there's no way. You're not going to find success in Dave's baby steps unless you're super diligent with doing it. You got to implement certain principles. And the purpose of this video is to just kind of like illuminate, shed light on the fact that these 4 biggest lies that he talks about regularly on his videos, I just wanted to kind of like shed light on them and show you that, you owe it to yourself to do a little more due diligence and dig under the hood. And, while he may be right about traditional policies, the way that kind of old school agents would create them, just because they can be the way that he says they are all the time, doesn't mean that's what you should do, right? And so I think hopefully that makes sense. And if it does, you have any questions, feel free to comment in the comment section below. And if you are curious about what this would look like in your life, how a properly designed whole life insurance policy could actually function as an emergency fund for you, how you could kind of take the baby steps in everything Dave Ramsey's doing and have the courage to kind of step out and look at something different, I encourage you to reach out, set up a clarity call, and we can kind of show you on a guaranteed basis, by the way, what this could look like, how you could take what I'm showing you right here and implement it in your life. Give Dave Ramsey a little bit of a heart attack, I'm sure, but here's the deal. Like, it's not a matter of what I think. It's not a matter of what Dave thinks. You have to kind of look at your life and your finances, your goals, your objectives. And what I can tell you is I truly believe that the way to get your each dollar that you have go through your life performing more than one function to create leverage without more risk for safe money, it's right here. That's what I believe. That's why I do what I do. And listen, I don't mean to like slam Dave too much. I do honor the fact that he's helped a lot of people get out of debt. But honestly, that's where his service ends. When it comes to educating people about all this other stuff, it's not a fully authentic perspective, not an authentic take, and he's totally kind of bastardized this concept and how whole life insurance works, and he's skewed it to meet basically his side of the story, which is a slanted and uneducated at best, if not misleading and deceitful perspective. So hopefully that helps. Comment in the comment section below if you need anything. Feel free to reach out. You can use a link to reach out to our team down in the description. And as always, have a blessed, inspirational day, and we'll talk soon.